A new signing drops. He took equity. Fans celebrate. But how does that pay rent? Hi, Mark here. I grew up watching football and counting coins, so I always ask the money question. Equity sounds glamorous, but equity means an ownership stake, not instant cash. And here's the twist. Only certain events turn that stake into spendable money. We dug into real contracts and real payouts. The pattern shocked me. The headlines scream big numbers, but the bank balance stays quiet until an exit shows up. Think about this famous story. A star held about 0.5% of vitamin water. When Coca-Cola bought the parent company in May 2007 for roughly $4.1 billion, that slice turned into around $20 million. Why did it pay? Because there was an actual sale. Rule 1. Find the exit plan. That is step 1. The media love buzzwords, but getting equity usually means waiting. It depends on the deal structure, the timing, and the firm's performance beyond hype. And not every space even allows equity. For example, in 2023, one major league barred non-family staff from team equity altogether. Different rules, different outcomes. Here's the cliffhanger. Even with equity, you might get nothing unless the right event happens. Let's open that door next. Headline hits, 0.5% at 200 million. Sounds like 1 million, right? Not so fast. That number is paper value, not cash in hand. Paper does not pay rent, only an exit does. Here is how the illusion works. Valuation times your percent gives a number on a press release, but your cut can shrink or never arrive because of two forces. First, dilution. When a company issues new shares, your percentage falls. Second, liquidation preference. That means investors get paid first at a sale, often 1 times or 2 times their money before common holders touch a pound. Now the happy exception. A star once held about 0.5% of a drinks company. When a global brand bought it for around $4.1 billion in 2007, his stake reportedly paid near $20 million. It worked only because the company was sold. No sale, no cash. Tip for the win. Always ask, which exit event pays me and when? Would you take $1 million cash now or 0.5% of a $200 million startup, and why? Hold that thought. Next, the few events that actually unlock money. Equity burns bright at launch. Will it light your bank? Not until the right spark hits. A new funding round is not a spark. You need a real exit. So what unlocks cash? A sale, a merger, an initial public offering, or sometimes a buyback or a secondary sale that lets insiders sell shares. Fundraising only reshuffles the table. It does not hand you chips. Even after an initial public offering, most insiders face a lockup, which is a period of about 6 months when they cannot sell. You can be rich on paper and still unable to touch it. Think of that famous beverage payout again. It paid because a real buyer wired real money. That is the lesson. Without a sale, that 0.5% is potential, not payment. In some corners of sport, rules even block equity entirely. One major league voted in 2023 to forbid non-family staff from owning team equity. So, in those cases, no exit will ever pay them on that front. Remember this refrain: fundraising headlines do not pay you. Only a bona fide exit does. Now, suppose an exit finally happens. Who gets paid first, and how does your slice shrink? That is where we go next. Your slice looked juicy. More forks arrive. Your piece shrinks. That is dilution. When new shares are issued, your percent slides down. And here is the other knife on the table: liquidation preference. It means investors get their money back first at a sale, often 1 times or 2 times, before common holders get a penny. Let me run simple numbers. Say you started with 0.5% at a 200 million valuation. After a couple of rounds, you end up around 0.3%. Now picture a sale at 200 million. Investors have put in 50 million with a 2 times preference. They take 100 million off the top. 100 million remains for common holders. Your 0.3% of that pool is about 300,000 before fees and taxes. The headline looked like 1 million. The reality might be a few $100,000 or less. Another crucial term, the cap table. That is the list of who owns what and who stands ahead of you at payout. Speed check. Ask for the cap table and liquidation preferences before you assume money will reach you. We have seen how the pie shrinks. Now let's decode what kind of equity you might be holding. You accepted equity, but equity comes in flavors. The flavor changes the risk and the taxes. First, stock. A stock grant is actual shares. You own them as they vest, and they can create taxable income when they vest. Clear and simple. Next, a stock option. That is the right to buy shares later at a set strike price. Your profit is the sale price minus the strike. If the share price stays below the strike, the option is worthless. Then RSUs, or restricted stock units. RSUs are a promise to deliver shares later as they vest. You do not pay to get them, but the value is typically taxed as income when delivered. Finally, a convertible note. It starts as a loan. It turns into shares at a future round, usually with a discount. It is debt first, equity later. Jump to the punch, read the term sheet, and highlight whether you have stock or options. That single line changes everything. Quick pit stop. If you are learning here, tap subscribe to Kickin' Riches and stick around for smarter money and sport. You know the instrument now. Next question. When do you actually earn it, and when can you sell? Timing rules the game. Deal signed this year. Full payday in 4 years? Yes, maybe. Startups make you wait. That wait is called vesting. A classic schedule runs 4 years with a 1-year cliff. The cliff means nothing vests until you complete year 1. At that point, about 25% vests. After that, more shares vest each month until you reach 100%. Leave early, and the unvested portion usually vanishes. It is a hard rule, but it is there to keep people engaged. Even after you vest, you still might not be able to sell. If the company goes public, insiders often face a lockup of around 6 months where selling is restricted. In private companies, you might need board approval or wait for a buyback or a secondary market. No plan for liquidity? Then plan on waiting. Speed check. Review your agreement for vesting length, any cliff, and any post-initial public offering lockup. If there is no path to liquidity, assume a long hold. You will wait years to access value, so protect that value while you wait. Next, the protective clauses that help you keep your slice from shrinking unfairly. You have equity on paper. Some contracts tilt the pitch. Good news! You can fight back with smart clauses. Start with MFN, or Most Favored Nation. That means if someone negotiates better terms later, you can adopt those same terms. You do not get left behind. Next, anti-dilution. If the company raises at a lower valuation in the future, this can adjust your position so you are not crushed by a down round. Then, information rights. That gives you access to financials, updates, and the cap table. It stops the darkness. You can see what is happening with your stake. Finally, consider influence. An advisory role or even a board observer seat is rare for endorsements, but if offered, it can give you a voice when decisions shape your payout. Speed to value. Ask your dealmaker, do I get anti-dilution and information rights in writing? Simple question. Big leverage. And always have a lawyer read the agreement. A single line can change 6 figures. Armed with better terms, you still face one relentless opponent. The taxman waits at the tunnel. How does timing and type change the bill? Let's open that playbook next. Equity lands today, no cash arrives, tax still knocks. Ugly, but true. Depending on type and timing, you may owe before you ever sell. Here is the simple map. Stock grants and RSUs usually create ordinary income when they vest. That means you owe based on fair market value at that moment, even if you keep the shares. Stock options are different. No tax at grant. But when you exercise a non-qualified option, the spread between the strike and the market price is treated as income. Later, when you sell, gains above your basis are capital gains. In the United States, long-term capital gains top out around 20%, while ordinary rates can reach roughly 37%. There is also the 83B election. File within 30 days of grant and you choose to pay tax on today's low value. If the company grows, you may save big later. If it fails, you paid tax on smoke. Cross-border players have extra homework. Residency and treaties matter. A United Kingdom-based athlete with United States equity may face both systems and must plan carefully. Guidance for today. Check if tax hits at grant, vesting, exercise, or sale. Plan it now. Next, let's spot hype and red flags before they cost you. They say you got shares. The press release glows, but the numbers are missing. That is a warning. Real deals come with documents and details. Here is how I test it. I ask, what percentage? Based on what valuation with what vesting? Show me the cap table. A cap table is the list of who owns what and who gets paid first at a sale. If they dodge, I walk. I ask for the exit plan. Is there a path to a sale, an initial public offering, a buyback, or a secondary market? If not, the stake is just poker chips. Watch the equity for posts offers. If the only plan is hype and your face on ads, where does real value come from? Also, beware internet myths. There is no secret prime equity clause or prime tax rule. Real agreements use standard venture terms you can name. The best athlete deals I have seen are boring on paper. Clear percentages, clear vesting, clear exits. Rule of thumb, if you cannot verify the percentage and valuation yourself, treat the offer as speculative. Now let's build a quick checklist you can use on any equity story you see. Time to simplify. I use a short checklist so the headline becomes clear. First, percent and valuation. What exact percentage are you promised and what is the current valuation based on? A low base can grow fast or die faster. Second, vesting and any cliff. Know the calendar for each chunk. No quarter earned means a quarter of your stake is gone. Third, liquidation preference. Who gets paid first and how much? 1 times? 2 times? And are there dividends or participation rights that stack above you? Fourth, the cap table. See a simple snapshot of who owns what. If you cannot get it, assume surprises. Fifth, exit strategy. What are the realistic doors to liquidity? Sale, initial public offering, buyback, or a planned secondary. No door, no cash. Sixth, protection. Do you have anti-dilution, MFN, and information rights in the agreement? Seventh, taxes. When do they hit for your instrument and where do you file? If the deal crosses borders, hire a specialist. Final refrain. Cash today and equity tomorrow both have value, but only one pays rent on time. Structure is king. You have the map now. Let's wrap this up and make you dangerous with headlines. We turned rumor into insight. You now see that a player's equity stake is potential, not guaranteed cash. It pays only if it is structured well and a real exit unlocks it. Percent matters, preferences matter, timing matters, taxes matter. Most of all, the exit plan matters. If this helped, hit subscribe to Kickin' Riches, drop a like, and share this with a mate who believes every equity headline is a payday. Thanks for watching. I want to hear from you. Would you trade a smaller cash amount today for a percentage that only pays on exit, and why? Or if you could ask just one question before taking equity, what would it be? I grew up counting rent money and loving the sport. That is why I bring you plays that protect your wallet. Read the terms, ask for the cap table, demand the exit plan, and keep your future simple. Cash today, equity tomorrow, but only one pays on time. You have got this. Stay sharp, stay patient, and I will see you in the next one.